Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
If you're interested in learning more about setting up your own family banking system, send an email to thefamilybankingshow@gmail.com. We'd love to hear from you.
Welcome back, ladies and gentlemen, to the Family Banking Show. We are your hosts, Derek, Rob, and John. Guys, how are we doing this week?
Good.
Back.
How you guys doing?
We're here.
Yep.
We are upright.
And
Talking before this, just how much of a day it's been for me. So I'm just thankful to just talk to you guys and be around like-minded, high quality people. So always like revitalizing.
Well, this week it seems like we kind of have a conundrum on our hands. We've been going back and forth before we hit record on what to do with windfalls. When you have a windfall, how do you position yourself strategically? What do you do with those dollars? And for our listeners at home, if you don't know what a windfall is, it's basically whenever you get a large chunk of cash that came out of nowhere, you didn't expect it. Maybe it was a long lost uncle that passed away and you inherited some dollars. Or maybe it's a bonus at the end of the year that you weren't anticipating or something like that, where you're just getting large amounts of cash that you didn't really have a plan for what to do with it. And so Rob has twisted our brains back and forth here on what to do with these windfall dollars. Rob, you had in mind sounds like a project or an asset of something to where maybe if you had 20K of a windfall and you had a $20,000 expense, do you try to do something inside of your infinite banking policies with that 20K, or do you just pay for that expense and be done with it? What's your take on this, Rob?
well, I'm going to actually complicate it a little further, because let's say you have a $50,000 windfall, you have $30,000 in paid up additions or premium you could pay, and then you have $20,000 left over, and you happen to have a $20,000 house project, painting the house, right? 20K. So what is the best use of that 50,000? And I think we're all in agreement, and we should have the cameras rolling half hour ago. We were going back and forth. But I think we're all in agreement that the first thing you want to do is put your dollars in to pay to your paid up additions or premium, because you want to keep your banking system going. You want to keep funding your banking system, right, your policies. And here's the other wrinkle. And I also have policy loans out there. So there's policy loans to backfill. There's paid up additions to purchase. There's premium to purchase, and additional paid up additions to purchase, and a project, and a set, and a windfall. Where do you put the dollars? And my opinion was, and we talked through this, but I think my opinion is, first thing you want to do is fill up all of your paid up additions, and all of your premium. If you have it due at that moment, fill all your paid up additions and your premium first. Get that paid off and taken care of. Keep funneling your family banking system. Then with what's left, then the question is, do you put it into outstanding policy loans, or do you pay off that with cash that you have on hand? Do you pay off that project? And my opinion, and this is where we can get into a little bit of debate here, and actually you guys can probably even convince my opinion, but my initial opinion was it didn't make sense to put that 30K back into a policy loan and then just turn around and take it right out again. Like, that didn't make any sense. But maybe you take that 30K and you set it up into a PDF. You start a new policy with that 30K. You take a policy loan. So now I have a 130K policy loan. 30 of that, basically take 30 of that to do the project, or 20 of that to do the project, and that other 30 to start a new policy. That's kind of where the debate is getting in. So sequence. So I think, to summarize it, pay up your paid up additions first, pay your premiums off first, keep your banking system healthy and thriving. And then now we're into the gray zone of what do you do with that cash on hand? So, John, what's your take?
I think we should define some assumptions first. I think the first assumption is that we're talking about people who are already practicing infinite banking. Like they already have
Hmm.
policies in place that are meaningful for their family. And another thing I think we should return to is just identify and define core principles of infinite banking according to Nelson Nash. And I think that'll inform the rest. So first and foremost, you finance everything you buy.
Hmm.
And so like fundamentally, when we're talking about paying for something cash, especially a $20,000 expense, it's like a flinch for, practitioners when we think like, why would you pay cash
Right.
for something that you could otherwise capture a lifetime of earnings.
Hmm.
So that's a big consideration, I think, in this scenario. So what are the five core principles? It's think long range, don't be afraid to capitalize, don't steal the peas, don't do business with banks, and rethink your thinking. And then apparently, according to the current president of the Nelson Nash Institute, David Stearns, who is Nelson Nash's son-in-law, said that if there were to be a sixth, that the sixth would be prepare for windfalls. And here we
Mm.
are.
Perfect.
So uh, I think the main
Yes.
thing that speak to me in this scenario, and when considering any windfall, is am I thinking long range, and am I trying to like truly capture what these dollars are going to mean to me over a long period of time. And if I just have, even at a smaller scale, like $5,000 windfall, mini bonus or something at work, and I don't really have much else to do with it, and there's like a vacation or something at 5,000, like I think it's most beneficial to understand that 5,000 isn't just a one-time consideration, but rather it has gravity, it has momentum that can be used against or for you. And if you put it into a policy correctly, it can be used for you. Um, that being said, I do think it's a wash if you repay a policy loan and then execute a policy loan of the same amount. I don't think that is much of a benefit. Um, so I think in this scenario, I think it's possible that there would be a need to expand your banking system, if not, create just an additional smaller policy.
Hmm.
Yeah, I
Hmm.
think the only way where it's not a wash is if, so you had, in this case, $100,000 of outstanding policy loans, which shame on you, Rob.
I'm using my system.
Yeah.
No, I think it's good to have outstanding policy loans. No
because
shame for policy.
you have a place to you have a place for your windfalls to go.
So, okay. So you had 100,000 outstanding, and those were all liabilities, right? The only time
Hmm.
where you would be money ahead is, okay, you take that 30,000, you paid off a policy, part of that policy loan that was a liability. So now you freed up that cash flow that you had previously amortized. And now you've got access to capital to go and use it, hopefully, for an asset. And now that
Right.
asset is generating a return and revenue for you. So you freed up cash flow from the liability. And if you had strategically positioned it to where now that policy loan could be purchasing an asset. So and that way you're actually doing much better, aren't you?
Yeah. Yeah. I would think and just as we're talking through this, the net, it's a policy loan doesn't know what dollars are you're putting in or doing what or taking out
Right.
or doing what, right? So if I took that 30K and put it right back in and then took it right back out again, it just to me it doesn't I feel like it has to be you have to be creating something new. So if I if I didn't have and see that's the kind of the this particular scenario is the expense is like an expense. It's a house project. So there's no return on it won't, there's no return on investment other than my wife is happy, which is massive, right? That's massive return on investment. But there's no like, there's so it's like it got the 20K to put down on a painting project. it just seems it might be, it's, gosh, that's like that gray area of maybe uh, do I start a new policy and then take, you know, take a loan against it for that? The thing is, like, as we talked about before, there's that initial startup cost of your banking system. So if I took that 20K and I started a new policy, I could maybe get, 15K of it. So,
Yeah.
it's so you have to consider that. If I can then, how about this? I can talk the painters into a 15K job. I can
Yeah.
drop the price down. Then I could start a policy, take a policy loan against it, pay the painting job, and then I'm net ahead.
Yeah.
But
I like that idea. I think 15 or $20,000 to paint your house is a lot. So I might have to
and that
send
might and that might be a lot, actually. I was kind of budgeting for that, but when I talk to people, they say it should be less.
yeah.
So I'm hoping that it
Yeah.
is. But just like we just thought this was kind of an interesting conversation for our clients because it's just like real world kind of questions. You've created your banking system.
Hmm.
You've been utilizing your banking system. You've been taking out policy loans for life, for emergencies, for repairs, for opportunities, and then a windfall comes along. What do you do? And you do have paid up additions left to pay, and you do have premium left to pay. Um, so what do you do with this set of circumstances? And I just thought it was a interesting real world conversation that might be compelling to folks who might be in the same situation.
Yeah. And depending upon how much debt you have existing on your mortgage, there might be a use case where it's like, all right, does that just go to pay down the mortgage? And how much time does that take off of the back end of your mortgage payments? I don't know.
Hmm.
Just spitballing ideas here, but it's there's different ways to think of things and how to structure it. And yeah.
Yeah, yep. Now we're getting into mortgage talk. A lot of the folks I follow, Todd Langford in particular, he's not a fan of paying off a mortgage because that's a fixed expense that gets cheaper over time, just like
Hmm.
whole life insurance,
Hmm.
and you have tax benefits from it. And so when he runs the numbers in his calculators, it actually shows you're typically off. If you take those same dollars you would have been spending to pay down your mortgage, if you were to put them into a new policy
Hmm.
or into something else, you tend to be better off down the road. But that's potentially a future episode. But
Yeah.
so so what would you guys do if you had like the same situation? John, it sounds like you would try to find a way to get those dollars back into something new. It sounds like your take at it.
Yeah, probably. I'd probably start something on my kids, additional smaller policy for a kid or even a business owned policy. But I think a scenario like that is pretty rare. That it's probably case by case and there's ways to strategize for sure. But I think
You
we
know,
define priorities like first priority base required premium.
hmm
Second priority PUA. And
Yep,
then from there, we look at outstanding policy loans and what you have available cash flow, moving forward. So
yep,
in that case, that's where we come in as, strategists to help you operate most efficiently.
right, yep. And also something to think about is the way we design policies is we like to include some PUA headroom in there. So you might have an opportunity to take some of like we typically when we create a policy, we illustrate a monthly PUA that you're paying, your base plus paid up additions, and that's illustrated in what we're like planning around. But often the contracts have more flexibility in the paid up additions area, so you might be able to add more to it. So that's just another thing to consider. If you come into that situation, reach out to us. We can look into your policy and see, okay, yes, you do have some PUA headroom. We can put those extra dollars in, um, if you happen to have it. So even if you feel like you've paid off your premium, you've paid off your scheduled PUA, you still might have some PUA headroom that you could put that extra windfall into. So it's something to consider.
Definitely.
Well said. Yeah, that my advice would be just that. Pay the premium that you already have that's existing that needs to get paid, and then anything on top of that is cherry on top. So fill up those buckets as best you can, as quickly as you can, and let that money flow.
Yep.
Yeah, and
And
if those buckets are constantly being full and you're just always running into this issue, that means it's definitely time to expand.
That's right.
Yep.
Create your
Yep.
additional credit union branch in whatever area you're in. And,
Yep.
yeah, build from there.
Yep, build your own banking, expand your banking system. Yeah, that's where I was going to go too, John, is if you start filling up these buckets repeatedly, that means you have more cash flow. And that's an obvious sign that you need to expand your family banking system.
That's
So
right.
something for our clients to consider.
Maybe the mortgage conversation is next.
Yeah, right? Yep, exactly.
All right, guys. Well, thanks for tuning into this episode. And for our listeners, if you're interested in reaching out to us and getting started with your own family banking system, feel free to shoot us an email at thefamilybankingshow@gmail.com. All right, guys. We'll see you in next week's episode.
See you guys.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.